Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Patricio Alvarez joining from his usual perch in Madrid, swinging across the ocean. We've got Mike McGlone joining from lovely Miami. I hope you're staying cool down there. And then up in the Northeast corridor, we've got Vince Piazza. So let's do a quick commodity check-in. Mike, I feel like you've always got a very provocative view on the commodity landscape. And just a quick check-in, Brent crude's in the mid 80s, about $85 a barrel here at the moment. What's your take? Where's oil headed over the next weeks and months?
Months, 50 weeks, maybe a little higher. And you remember I said that like 2 years ago for 50. Yes, a bit early. We've had a few circumstances that kept it bid, which I think is tilted lower. But first, I want to give you the broad thing for commodities. First of all, you look at the most elastic commodities, the grains. They responded the most to this big pump in prices due to Russia's invasion of Ukraine. And by the end of this year, unless there's a really bad corn belt weather year, we should make new lows in corn, go back to where they were before the cycle, because there's just way too much supply. I tilted over the crude oil. It's a little less elastic, but we're in the back end of the high price cure. I look at, first of all, the macro, just stuff I'll be publishing tomorrow, my energy outlook. You look at 10 years ago, crude oil was hovering around $100 a barrel. It dropped in 2014 to 40. It first traded 40 in 1981 when we had that war with Iran, Iraq. And then, of course, it got to its peak there when Saddam Hussein invaded Kuwait. 40 is the key pivot. I think we're going there. And then I look at what's changed since 2014. Back in 2014, the U.S. was importing 5 million barrels a day. Now we're exporting 3 million barrels a day. Back then, the average yield in a Chinese 10-year note was about 4.2%. Now it's 2.2%. China's collapsing. And then you look at the key thing I think that's really going to matter is I'm worried about the U.S. stock market. I mean, it drives crude and crude can drive it. Back in 2014, market cap was 1.3 to GDP. Now it's 2x GDP. So that to me is part of the risk. I think crude oil is going to head lower. It's going to follow that example of natural gas. It has to get to that low price cure, kind of shut off the issue. And then it would just point back in the macro that really happens over time. I just kind of reread a little bit of my Adam Smith, The Wealth of Nations and The Invisible Hand. Commodities is always about going and hovering around the cost of production. The U.S. is $55 a barrel. You basically got to get below that. Now, we did it in natural gas. We got below 2, hung out below there for a while. We pumped up to 4. I say 4 because the Jan contract has been above 4, which means in December, that'll be the top month. So for natural gas to be a 4 handle, it seems a bit dicey. But futures positions are well positioned for natural gas. They're way too long to go higher, and they really sold out at crude oil. So we can tilt over that later, but I'm still bearish on crude. And I kind of a little bit more bearish on natural gas too because of these managed money net positions for about the longest they've been in 2 years at this time of year.
Yeah, fantastic, Vince. I think you might have a slightly different view on the market. So curious to hear your reaction. What do you think about the commodity landscape here at the moment?
Yeah, so we're in the summer season, the summer cooling season. Nat gas is getting a little bit of a bid. It had a bid earlier in the month. We were looking for it to touch $3.50 to $4. Earlier in June, mid-June, we got to about $3.12 on Henry Hub because of the early heat. We're a little cooler heading into the 4th of July holiday season, and that's why you're seeing spot retreat. But it's really going to come down to summer heat in July and August to really drive the benchmarks. On the production side, nat gas production is below 100 BCF a day. That's pretty much in line with our views. On the consumption side, pipeline exports down to Mexico, they're down week on week. LNG feed gas is down week on week as well. Part of that is maintenance. So we're getting the response on the production side. We aren't really seeing it on the seasonal or the cyclical consumption and more the structural demand side. But I think we're primed for that because we are working off the storage surplus. It's coming in nicely, I would say. So we feel pretty good about that 350 handle that we talked about in our focus idea earlier in the month of May. So I feel better about it. We did say we were going to be off the lows, and we were off the lows below $2. So we do have a little tailwind here, and I think it'll definitely play through. Producers are definitely scaling back, although EQT brought back some molecules as price did rebound. But for the most part, we're seeing the discipline hold. And if we get below 100 BCF and sustain below 100 BCF a day, all we really need is for the maintenance to come back online, the facilities to come back online from maintenance. And I think we're in pretty good shape.
All right, very interesting, Vince. And for anyone who doesn't know it, Vince has a focus idea on this topic. On your terminal, if you want to see all of our focus ideas, you can type BI space focus. You can go see Vince's. Focus ideas are basically kind of our highest conviction, often out of consensus calls. So check them out. Very, very interesting space to maybe inspire some of your thinking about the market. Patricio, let's swing around to you. You've got an interesting note out recently on the European gas situation. And tell us about your outlook for where gas in Europe could be headed. I know there's a big disconnect between European gas prices and U.S. gas prices, but how's Europe look?
Sure. So our note basically argues that perhaps it's just sentiment that is driving near-term European gas prices at the moment. So we're talking about supply risks in the form of headline risks. There's been talks that soon flows transiting via Ukraine could cease earlier than expected. We expected them to cease by the end of the year. It seems like they could stop before that. So that's one risk. There's also trade tensions for LNG in the Middle East. And also there's always potential outages for maintenance in Norway and also in other sort of LNG hubs around the globe. And of course, you have the talks about potentially sanctioning Russian LNG, which I think if you look at these supply shocks individually, they're not massive. If you look at the supply, the gas demand balance here in Europe, so discounting for that, the demand outlook for gas domestically in Europe remains very much weak. There's been a very, very subdued recovery in industrial activity. That's without accounting for any weather impacts. We're seeing very, very weak signs of industrial demand activity. And we don't see a lot of upside for demand. So demand in Europe is still roughly 20% below what it was in 2021. We think it could recover 1 to 2% this year. And the fact that we think there's potential for a stronger recovery in power, that sort of shows that there's a bit of displacement now from renewables, and perhaps that a lot of that demand for gas will not make its way back over the long run. So just looking at those two sort of the fundamental picture for demand within Europe, we think European gas prices are actually perhaps being a bit lofty at the moment at 35 euros per megawatt hour. We think if these supply risks don't materialize by the end of the summer, we think that there's potential for the forward curve to actually shift down. At the moment, we're talking about winter prices of around 40 euros per megawatt hour. We think on an annual basis, European gas prices could hover around 30. That would be the average for the full year, we think. And of course, that assumes that there's more of a demand pickup in China, which which has seen rising LNG imports. But again, there's also an influx of new LNG liquefaction trains coming in online on the second half of the year. So these are the sort of the driving factors that lead us to believe that there's not a big potential for upside in gas prices here in Europe.
I gotta ask real quick. Oh,
Can I just piggyback on what Patricio said real quick? We've been watching a lot lately, hedge fund positions, most notably in natural gas. I mean, they really helped put a peak in WTI crude back in April and put that low in a few weeks ago. And right now, in U.S. and European natural gas, managed money net positions, i.e. hedge fund speculators, are the longest they've been since Russia's invasion of Ukraine. So they're priced for much higher prices, which means the risk is, as Patricio says, that we go lower.
Yeah. Patricio, I was going to ask you just a quick follow-up, less technical than what Mike just brought up, but just we got an election in the UK, elections in France. Is energy part of that discussion? When Russia invaded Ukraine, Europe seemed like the policy makers were rushing to get off of Russian gas, and we've seen LNG from US fill some of that gap. Is any of that even filtering into the conversation or narrative? Does the politics of Europe matter for any of this stuff in your mind?
So I think policy definitely matters over the long run. So we did a note, we wrote a note on what it could mean for French utilities, especially. So for France specifically, we don't see a potential for an upheaval in the nation's energy policy over the long run, and that's mainly because France is it's Europe's nuclear powerhouse. They hold most of Europe's nuclear power capacity, and it's the incumbent government, the current government, and the potential right-wing government that could come in the future. Both of them have been talking about lowering power prices by utilizing and expanding the nuclear capabilities in France. I think the narrative is fairly similar for both. There are risks for a potential rollback of subsidies for wind. And again, France having already a very relatively clean power stack, given they have hydro, they have nuclear, and they already have quite a bit of solar as well. We think that the potential downside from a rollback of wind policies is not major. It's not very big, given that utilities that are in this space have invested mostly outside of France. Moving into the UK, very briefly, I would say that although there is not a lot of detail in the manifestos for the Labour government that could potentially take over in the next few months, the fiscal constraints that the UK has won't allow it to stimulate a lot of new subsidies for clean energy anyway. So in that sense, I think you could wrap it up by saying there is very little fiscal headroom for policy to make a lot of changes. If there's anything, it's potentially more discipline and potential rollback of subsidies. But with no clear discussion, let's say over the long run, there hasn't been talk of boosting fossil fuel use over the long run, because really there's not a lot of resources or reserves here in Europe. We look set to continue to be a net importer of fossil fuels, not an exporter. And I guess that's why technologies like nuclear and wind and solar are sort of the only options.
Vince, political question for you as well. We got an election here in the States this fall. We've seen a lot of energy politics. Maybe policy is different than politics, but we've had the pause in LNG permitting from the Biden administration. I believe former President Donald Trump is talking about rolling back the IRA, some things like that. Does any of this stuff matter for any of your companies? Do you think it has market impact, or do the gas market, oil market just sort of function independently from some of these political questions?
I think oil and gas, the legacy oil and gas industry has dealt with civic backlash and regulatory and legislative backlash for years now. So I think they're in there. The industry itself is in this maturity phase and looking at a way to evolve, not just with respect to environmental policy, but how does it continue to do its business? And we've looked at this and we've published a lot about it, and how does E&P upstream evolve over time? And a lot of what we're seeing, and a lot of what we talked about, we're seeing now. So bigger, more concentrated, more nimble producers, operators with less debt. And we're seeing M&A take a stronger foothold as smaller entities become larger. We see them more concentrated, and we see the concentrated operators outperforming the more diversified operators. It's an easier story to tell when you're walking into your PM's office or you're walking into your investor's office and saying, hey, XYZ is the largest producer in this basin or that basin. I'll give you an example. We talked about in a recent note that we put out, Diamondback Energy was a relatively small operator. It used a relatively higher equity valuation, so a higher currency, to pick up smaller operators, and now it's undergoing, it's integrating its more recent transactions, and it's also announced a very sizable transaction as well to become one of the larger independent operators in the Permian Basin. So concentration matters, using your multiple to engineer metrics. You're buying a lower multiple operator. You're bringing those operations in-house. You're generating free cash flow. That free cash flow in turn goes out to your shareholders in the form of higher dividends, and at times buybacks as well. So there's shareholder engagement, shareholder buyback, shareholder support for all things that you're doing in terms of redistributing the excess capital. So concentration over diversity, and M&A to build your resource base to have inventory in the future. And we put this out just the other day, yesterday, in fact, and you can hit us up offline if you want a copy of it. But a lot of these things that we have talked about over the past year or so, we've merged into a fairly sizable deck that we're looking to leverage some more, and maybe a deep dive down the road.
Vince, I'm curious, in your mind, with some of the ideas around capital returns, shareholder returns that you just mentioned, is there an oil price or a gas price that's necessary to allow that? I guess we're going to come back to Mike in a second, but I guess my point is, if Mike's bearish view unfolds, does that sort of pause all of that kind of activity in your mind?
Well, I think what it does is sort of accelerate the decision-making process for a lot of these smaller operators. These smaller operators probably have less access to capital than the larger operators. And that differential in multiple likely expands. So your larger operators who are better able to withstand the commodity volatility would be in prime position to consolidate the industry even more. But in general, M&A decks tend to work out $70 range at $2.75 with $3 nat gas. So that tends to be sort of that magic numbers. But in places like the Eagle Ford or the Permian, where break evens are in, call it the 30s and the $40 range, that's a lot of embedded upside if you're staring at a $70 or $80 handle. So it's not so much the price, but price stability that offers the acquirer an opportunity to make that decision. In periods of extreme volatility, there's less appetite. But if I know we're in contango, and if I know that price is fairly stable and it's less clouded, the economic landscape, the political landscape is less clouded, I have the opportunity to step up and make that capital allocation for inorganic growth.
Mike, I want to get your reaction to some of the discussion here from both Patricio and Vince. And one of the questions that was kind of on my mind is, you had already mentioned technology and, the marginal cost of production is sort of maybe driving where oil prices could clear and go lower potentially. But I'm curious, you look at some of the technicals, you look at technology and costs and maybe politics, and what of the variables that kind of feed into your calculus, what do you think is really the most important in, say, the medium term, when you think about where these commodity markets go? Is it technology? Is it cost basis? Is it politics?
It's all the above. First, politics. Drill at will from Trump 1.0 is probably going to happen Trump 2.0. And I fully expect a weaker dollar, which might be good for some commodities. But overall, it's bad for price of crude oil. It's deflationary. At least everything else he talks about is inflationary, but it's deflationary. And he basically, at least he attempts to do what he says. So I fully expect that from the politics. From the macro, the bottom line is the overwhelming force of what typically happens in commodities when they get too expensive. They always have to get too cheap. And what stops that? You just have to see what's changed. That's why I think we're in that too cheap phase. I mentioned natural gas has done it. We got too cheap. U.S. natural gas. European gas, as Patricio mentioned, is probably still getting there. We have to get too cheap. He's pointed out the demand just shut off. For reasons, that's usually what happens. For crude oil, I like to point out is, to me, everything for crude oil right now is pointed towards that lower price cure, maybe starting to kick in by the end of this year. First of all, obviously, the stock market has to go up. And I point out from my colleague who's based in Hong Kong, Hainek Feng, who just wrote out 4 crude demand charts underscore China's economic struggle. I look at the macro, look at bond yields, they tell you they're in a deflationary recession. Now, he just pointed out a few things we don't have to dig into. Let's look in the facts of the U.S. We have declining demand for diesel. Diesel demand in this country is about the same as it was 10 years ago. It's never happened. Our database goes out 30 years. We've never had flat diesel demand for that long and go down. It's about 7% from that peak in 2007. So that's the grease of the economic economy. Gasoline demand is declining, and container boards all going down. So I wrote a piece recently. It was typically in this environment, you go back to an average price. So I fully expect the average gasoline price in this country, which is about $3.50, to go to $2.86. $2.86 is our long-term average for 20 years. Diesel, right now, the average price of diesel in this country is about $3.50 or $3.70. The long-term average is $2.50. I fully expect it to go there. Demand is declining. And container boards. The thing is, all these things are not as lined up as they are now during the last recession. Like containerboard demand preceded. Diesel demand did not start plunging until 2009. All this stuff is heading lower now. So you have to ask yourself, what stops that? Almost always, it's low prices. So I look at this from a macro, technical, fundamentals, political. The normal price cure is, at least for the last, since 2014, has been $40 a barrel. $40 was the high when we had the Iran-Iraq war. And guess where that ended? At 10, when Saddam Hussein invaded Kuwait. That bottom 10 years later at 10. So a normal bottom is 40, and you have to ask yourself what stops it. I don't know, but I see those trends heading all that way. And I look at macro commodities. The only one I really see going up over time is gold, and maybe some copper. But again, you got a rope in China there, and the whole tilt of this paradigm shift with the unlimited friendship is just so bad for those commodities that China helped pull up for the last 20 years to just go back down to the normal cost of production, get below that cost of production in the largest producer, which is the U.S., to reset that supply versus demand. But I point out to me, these are just facts of the trends. And I look at it as what's going to trip this up. I don't know what it's going to be. So I'll end with this. One key thing I look at from the most elastic place is I have to look at corn. Why do I mention corn? Corn is to food what crude oil is energy, but it's also fuel in this country. Almost 15% of total unleaded gas now is from ethanol. And it's just that typical cycle that with technology, we can produce way too much. And we use less. Well, actually use more, but we just produce way too much. And it's just a question of what stops it. You basically need one bad weather year and corn will pump up, and that's what will happen. South America will bring on more supply. U.S. will bring on more supply next year, and prices go down. That's the stage we're in right now. Crude oil, it's heading lower. We've had a little bounce. Positions got way sold out on that bottom. They're starting to reset. And once they reset, we just probably cycle back down. I just need a good reason for it to not go up. And these regional wars are just keeping that major thing that's pressured crude oil since 2008 peak, is that excess supply out of U.S. and Canada.
Mike, I'm curious. I'm just looking at the S&P 500 return year to date. Looks like we're up about 15%. Uh, if you look at the energy subcomponent, it's lagged a little bit, and I think some of the narrative is that the AI stocks, the Nvidia's types of companies are driving a lot of that return in the S&P 500. What do you make on sort of the energy contribution to the overall market performance?
So I think it's significant. Back when we started the COVID situation, that was a trend. First, when energy got negative, we all realized energy was way too low, underweight in the indices. It's caught back up, but now it's going to be its own worst enemy. Typically, when prices go up, energy prices go down. But it's like Vince pointed out early, the system is getting so efficient with creating more, using less at lower costs, and demand is going way down because of things like BYD and UME driving EVs. It's great for the lessons we learned of history is that the equities will do okay. But they create more with less. But the actual price of that commodity is just deflationary, unless humans are going backwards, and that's why the only one that really goes up over time versus like money supply or inflation is gold. And you price almost all commodities in terms of gold, they go down. So I look at it as you have to mention the stock market now because the U.S. stock market at 2 times market cap GDP on the way up. The last time we did that and got that high was 1929. We all know how that worked out. So it's all that really matters. It's that expensive. And I just like to point out the last time we had a similar pattern of crude oil getting contracted in a cage like this was around 2014. It broke down, and stock market cap to GDP was closer to 1 then. So to me, it's also when you're running money and a hedge fund and you have the value risk model, we all know what happens when beta goes down. Crude oil use and copper use go down about double the velocity. That to me is the risk, is just a beta having a little bit of mean reversions. Crude oil's already doing it. I'm glad how you started. As I pointed out at the beginning of the year, is basically have to have the U.S. stock market go up for copper and crude oil just to remain somewhat stable. And you see how they're underperforming, even though they're higher volatility markets. So what happens when beta has a normal back and forth of a bull market? I mean, we haven't had a 10% correction since that bottom in October. We'll get it. And I like to point out early, we had a quiz this year. We got down 5%, crude oil collapsed, copper collapsed, Bitcoin collapsed. They're just waiting. I mean, everybody who's running hot money, who are way overweight things like natural gas and copper, they all know their stops will be hit if we just have the S&P 500 drop more than 5% for a normal correction in a bull market.
Vince, over to you.
So if you think about it from a longer term perspective, energy during the commodity super cycle was double digits within the S&P 500. We bottomed out during COVID somewhere around 2%. Even after this rally and rally off the COVID bottom, energy is still roughly 3.5, 3.6% of the S&P 5. So, investors are looking elsewhere for that type of exposure. And really, when you take a look at what's in the energy index, most of that composition is in the 3 biggest names. So if you get Exxon, Chevron, Conoco right, you pretty much have the entire sector right. And that's where the concentration is. But if you walk into, and I'm just making an assumption here, if you walk into an endowment, if you walk into a public pension fund, I can tell you that they would rather not see legacy energy in the top 10 positions. So I'm not really sure what gets us out of this somewhat struggle for legacy energy relative to the broader S&P. Tech is roughly 33% of the S&P. It's a third of the S&P, and a lot of that is in a few of the tech stocks, right? But legacy energy seems to be in this struggle. Part of it is with itself too. Even if you merge, you're not really growing that. You're just combining 2 entities and just getting a bigger slice of that composition. But I have to say, even at $80 plus oil and $3 plus gas, you're still stuck in this 4% of the index, which is somewhat of a struggle for a lot of us who've been at this game for a while.
Well, if you're worried about the traditional energy component of the S&P 500, clean energy is almost zero. I think First Solar is the only name in there right now. A couple names dropped out over the last year or so, and they've had a good run. They were one of our 50 companies to watch for the year that made it into Business Week. Patricio, I want to swing over to you and get your perspective on this, because it's actually interesting. In Europe, the energy majors are actually a bigger share of some of the indices. The FTSE there in the UK has a bigger energy composition than the US. And I think part of what's happened there is that Europe doesn't just have this big outsized tech sector piece, but how do you frame where gas, utilities, energy, these kinds of things are at in Europe relative to the overall market there?
Yeah, so I've just pulled the numbers, and at least for European utilities, and that includes both gas, power utilities, and some renewable developers as well. The share is roughly 4%. So the Stoxx 600 utilities index represents roughly 4% of the broader index. And yeah, to your point, that's, if you look at the correlation with interest rates, if you look at the 10-year yield for euro bonds, that's roughly what you're seeing. You're seeing a decline. It roughly peaked at around 5% in 2022, and since has dropped to around 3.7 or 4% over the past few months. And why is that? Yeah, well, if you look at the performance or the year-to-date performance of the broader market here in Europe, looking at the Stoxx 600 index, it's up around 7.5%, and the index for European utilities is down about 4%. So we're clearly underperforming the market. That's a combination of things. It's normalizing power prices, so the cyclical earnings upside for the utilities we cover is just fading away. Higher interest costs mean that these are very long duration equities, so these get impacted more than most. And also their ability to boost a dividend or the dividend yield to sort of allure or appeal to investors has been weakened as well, because this is also the highest leverage sector in the broader market here in Europe. And finally, I would say I would agree 100% with your assertion that the market, or at least the FTSE, is for sure one index in particular in the UK that has a lot of sort of legacy old economy type of equities, and the technology sector is very relatively incipient if you compare it to the US. For sure, there's a few fintech companies in the index, but they're relatively small.
I love the way you frame it. Made me chuckle a little bit. I'm sure the UK is somewhat wrestling with the future of their economy, and they do have a sort of great history there that's represented in their index. I'll just quickly note, if you think year underperformance is bad, solar stocks are down about 20% year to date. Wind stocks roughly flat. So make sure to check out our mid-year outlooks to kind of get a sense of what's going on there. And since it is, we're at the halfway point for the year, let's close out and do just a quick round robin with each of you, kind of 30, 60 seconds. As you look to 2H and even beyond, what are you watching most closely? Mike, we'll come to you first. How's 2H going to shape up? What are the things you're watching?
Just so there's no confusion, I expect the price of crude oil to be lower. I think the biggest risk is the U.S. stock market goes lower, and that is a scenario for severe deflation worthy of the significant inflation we got on the back of the biggest money pump in history and the longest period of zero interest rates ever. So to me, that's a tilt for 2H.
Fantastic. Vance, over to you.
Key M&A in the natural gas space, kicking off another wave of broader consolidation, and winter 24-25 better than expectations will probably drive a better nat gas backdrop for the nat gas centric operators.
Okay, Patricio, we're giving you last word.
Yeah, so after a very weak first half, we expect electric utilities to improve in the second half, largely because they just had a very tepid one H. That's mainly driven by lower power prices. I think those are mostly power priced in. We think margins will actually fare better than what consensus expects, mainly because the drop in gas prices means that their energy procurement costs are going to be lower than their hedges. And the other key point for us is that we expect a stronger recovery in power demand versus gas demand, and that should sort of perhaps cement a more sort of longer term recovery in the outlook for utilities, which we think over the long run is still bolstered by this mega trend of electrification and higher demand for electricity.
Yeah, fantastic. I'll just quickly go too. If you're looking at the wind space, uh, the wheels really came off during COVID and the pandemic. Most of those companies got really beat up. We're seeing some momentum there. Part of the story is one of the commodities, steel. We didn't talk about steel, Mike, but steel prices have really come down from their peak level. And a lot of the wind names got caught where they had sold turbines and they hadn't hedged their steel prices. They had profitability get eroded, and we're seeing that big profit recovery there, still continuing to unfold in the wind space. Solar names going through a bit of turmoil. Why are they down 20% year to date? Based on the median company, well, it's because module prices have just fallen. They're down over 50%, about 60% over the last 2 years. And so it's been very challenging for companies to adjust to that new, much lower price paradigm. There are some exceptions. I mentioned First Solar earlier. Why are they an exception? Well, they've got tariffs protecting them. They've got the Inflation Reduction Act, things like that. So very interesting time in energy land. I want to thank everyone for their time this week. We do have these calls every Wednesday at 10 a.m. New York, 3 p.m. London. Feel free to spread the word if you want some of your colleagues to join. This is an open forum. And if you asked a question in the chat and we didn't get to it, we'll try to revisit and reach out to you offline. But reach out if you have any questions on any of these topics. Mike, Patricio, Vince, myself, we're all green dots on the terminal right now, and we look forward to engaging with you on any of the material we covered here today. Hope you have a great rest of your week.
Thank you.